Good afternoon, everyone. Welcome to another one of our Wednesday market reviews. My name is Stock Darts, and as usual, we're going to do the following. We're going to go ahead and take a look at the S&P 500, the NASDAQ Composite, the Dow Jones, and the Russell 2000. Once we finish looking at the markets, we will go ahead and take a look at the U.S. dollar, see how it's behaving, see how it's affecting gold, silver, and see how oil's doing. Obviously, at this point, not doing too hot. And once we conclude that, we will go on and move on to chart requests if anyone in here has a chart request. Those of you that are in here, if you have a chart that you'd like me to look at, just go ahead and type it in the chat, and we'll get to it when once we finish covering the broader markets. If you like what you see here, you can follow me at Stock Darts on Twitter. You could find these videos on YouTube at Stock Darts, or you can visit me at patreon.com/StockDarts, where I post weekly blog content, including ideas on specific trades or names that I'm watching, or just different ways that I implement some of the strategies that we discussed during these Wednesday market reviews. Other than that, let's go ahead and get started. First thing we're going to do is take a look at the S&P 500 with the ETF SPY. And as we can see, things are still pretty ugly. The market is still, I think, in a full-fledged panic. I think the entire nation is in a full-fledged panic. And we have yet to really get a sustainable bounce. And that's kind of unfortunate. I thought by now we would have at least had a bounce, even if it was a dead cat bounce. And it looks like maybe the dead cat bounce was just that 3-day bounce that we had in the beginning of March, and since then it's just been a free fall. And while I am seeing signs of buying, I saw signs of buying last week and the week before that. And what ends up happening is it looks like we begin to establish a bottom, and it looks like buyers are stepping back in, and then overnight there's bad news, and before you know it, the next morning we gap down again and continue to head south. So. You know, it is what it is. It's been like this for a few weeks. So those of you that have been coming during these last few Wednesdays know that I've been recommending kind of staying away. I didn't think that the selling was done. I still don't think the selling is done. However, I'm a little bit surprised that the volatility continues to increase. I would have expected by now for things to quiet down, and despite the fact that I think the market is still going to be heading lower and is still going to be testing and probing down to figure out where buyers are, it's always a shock at how quickly it can happen and how far down the market could push. You know, we're hitting levels that I expected us to hit, but maybe in a month or two from now, not necessarily where we are now. And that's tends to be the nature of the way these things work. Ray, I don't know, is it lower than normal? Let me see, maybe if I move the mic closer. Let me know if it's still low. It might be on your end if not. So, you know, we're kind of in the same place we've been the last couple of weeks, in that the market is still struggling. However, I think at this point I've started to see signs of strength popping up in different areas of the market, and we'll discuss that in a little bit more detail once we cover the 4 major ETFs. But no, Ray, I think just pump up the volume on your PC. If anyone else is in here, if I'm too low, let me know. But as far as I know, none of my settings have changed, so the volume should be the same. So, you know, the one thing I've noticed is that we're starting to see some parts of the market pick up a little bit of strength, and more than anything now, we're still getting hammered, but a lot of it is due to some energy names that are really struggling, and of course stuff like the cruise lines and the airlines that still struggle to get a bounce. And until that changes, the markets and the indices in general are going to struggle. But at this point, you know, it's going to be the same thing as what we said the last couple of weeks. You know, if you're not someone that trades actively, you're probably better off waiting. You know, and this is the kind of time when you want to start building up a watch list of stocks that you feel you want to get at a discount. We're starting to get into basically the same area that we were in 2008, 2009. Now, unfortunately, we're just a few weeks into a move like this, and this could end up being something that lasts for a few months. But what ends up happening is when the dust settles, you're going to have a lot of names that you could buy at big discounts, and you want to add. You know what they always say: you want to buy buy the blood, or buy when there's blood in the streets. And I would say at this point, it's pretty clear that the market has blood in the streets. And while I do think we are going to head lower, I think at this point it would be wise to start looking at names you want to add. Figure out levels you want to add, and in some cases maybe even start adding as we, where we are right now. And like I said, we can explore some of that in a little bit more detail once we cover the 4 major markets. But for now, we're kind of in the same boat that we've been. where it's difficult to short because we're so overextended to the downside and we're so oversold that we're due for a bounce. And unfortunately, the risk reward just is not good and has not been good for a short in the last week or two. Um, and really, the only traders that have been able to take advantage of this are momentum traders that either are day trading or trading very short term as they trade breakdowns from flags or just being aggressive and shorting and at the at support levels. Um, yeah, I don't know what to tell you, Ray. No one else is having a problem. So at the moment, really the only thing we could do is either wait for a bounce or well, wait for a bounce and either trade long if you're looking for a bounce, or wait for that bounce and then start resuming shorting stocks that you feel are going to get hit and are going to continue dropping. Other than that, we really, like I said, this is not the time to be aggressive. This is not the time to try to get cute with your trading. This is the time to be extra cautious. During the last year, I kept advising on trying to take advantage of the market as it climbed higher relentlessly, because that was an easy market. That's the kind of market you want to take advantage of. We're in a different spot right now. We're in a market that you do not want to try to get overextended and try to trade too aggressively. This is the kind of market that unless you're very comfortable shorting and you're very comfortable with day trades and taking advantage of the intraday volatility, you're better off kind of standing on the sidelines and just waiting for things to clear a little bit, and then look for names that you like or names you trust and try to go ahead and get those at a discount. If we go ahead and take a look at the weekly chart of the S&P 500, you'll see that we've given up a lot of ground, and we're very close to losing the pivot low that we formed at the end of 2018, which is not a good thing. And if we lose that, well, I mean, there's even more room to the downside. But at this point, we sliced basically through the entirety of the range that we've spent the last couple of years in, from 2018 to maybe the end of 2019. And then of 2020, we broke through that, and that was a very bullish move, and things were looking great. And then now we've had this issue, of course, with this pandemic, and we've sliced right through that in a couple of weeks, through the entire range. At some point, we're going to bounce. Obviously, the government is injecting a lot of money into the markets, and with the idea of trying to stop it, trying to stop this drop and trying to, inject more demand into this. And until we see it happen, we just, like I said, we have to wait and see where the dust clears. But I suspect that we should bounce soon. Now, again, I've been wrong the last couple of weeks. I've been expecting a short-term bounce for 2 weeks now, and we just keep dropping further and further. But at some point, this has to slow down, and we have to find a bounce. Now, just because I suspect there's going to be a bounce doesn't mean that it will happen. And even if it does happen, it may not be the type we're looking for. So I'm still being very, very cautious about what I trade and how I trade it. I'm making sure I see conclusive evidence of a bounce before I take a trade on any name. And I'm being very picky about the types of names that I trade. And I'll go over that in a little bit more detail. Like I said, I'll mention some of the names that we went over on our Patreon page once we get through looking at the markets. But like I said, there are areas of the market that are starting to behave better. And more than anything, are not going to be hit as hard with the government shutdown or with people being sent home as some other names might be. So, we'll explore those ideas in more detail soon. Now, we have to analyze the levels here. Like I said, we're kind of in uncharted territory as far as how swiftly we move down and what we can expect. But like I said, we're moving into a level of support that if we lose, you can see on the long term, we have a long way to go if we lose this level of support around this little pivot that we had at the end of 2018 when we had the market sort of dip real fast. And if we lose that, well, we're going to come all the way back down to, and you can see I have to zoom all the way back to the 2015 to 2017 range. And really that's the next level of substantial support, way down here at 213 on the S&P 500 on SPY. So there is room for a lot more downside. Shockingly, we didn't get support up here around the 250s. And if we don't get support around here in the 230s, well, then I think it's another free fall all the way to the low 200s. And, like I said, it's scary. It's an ugly thing, but sooner or later the market will rebound, and sooner or later we'll start to recover some of this drop that we've had. But until we see that, we should just be patient and be cautious and not try to get overly aggressive about this. The same as traders that try to call tops. You don't want to be the guy trying to call the bottom every time that we drop. You want to wait till you see some evidence of it, and then from there go ahead and try to take advantage. Alright, let's go back to the daily chart now. And as far as resistance, right, so there's really not a lot of support other than where we are right now. We've just developed a new level of resistance right around 256, 257. Now that was supposed to be support, and we kind of broke right through there pretty quickly. We had this one attempted bounce, and then we came back, and I'll zoom in and you can see the selling pressure right here. Right, so we had a drop through there, and we tried to kind of hold there. We didn't. We failed, and we closed down low. The next day we broke back above it, but then we followed through in these last couple of days. You can see the wicks as we tried to break back above 256 and failed. And what we're doing today again, where we tried to make our way up and are at the moment failing. This is going to be the first level of resistance, and if we do get a bounce, we need to break through that. That's going to be a critical level to break through. I think if we can break through that, then we can maybe have a sustainable bounce of a week at the very least, and then maybe we can start making our way back up into the 260s, 270s. At this point, I don't expect us to get back into the 290s to 300 range. That should be something that's just in the rearview mirror, and that's something we're not going to see for a while. The next step really is for the S&P 500 to come and test the 20-pair moving average. And I think when we test it, we're probably going to turn right back around and head down. And we're not going to test it up here in the 290s. My guess is that the 20 period is going to come down and meet price somewhere here in the 270s, assuming we could bounce over the next couple of days and start to make our way upwards. And the big key will be to actually get price action above the 20 period. It probably won't happen on the first test. It may not happen for a couple of tests. So for now, I would say the key is really we want to see price action back above the 250s. At the very least, what we want is to be in the range that we've spent most of the last 2 or 3 years in, which is this range between about 290 and about 255, 256. So that's a critical area, and that's one of the most important lines or most important price levels that I'm going to be watching across the 4 major ETFs right now, is as far as the market indices are concerned, is the S&P 500 getting back above 256. I think that's going to be critical, and that's going to be a spot that we need to really pay attention to. Above that, like I said, we have resistance. It's going to, up here in the 280s and more resistance up here at 290s, but I think at the moment the critical resistance once we get above 256 is going to be the 20-pair moving average. When you have a market moving this quickly and this strongly, rather than looking at the horizontal levels, one of the keys is to watch what we do as we start to come back into those moving averages. So the key right now is 256 and the 20 period, and then to the downside, really where we are right now, and a little bit below that. If we lose the 235 to 233 level, then it's going to get ugly again. So hopefully we can hold those levels. Now you'll notice with the NASDAQ that, relatively speaking, we're still stronger, the S&P 500, but we're starting to catch up as far as dropping down. We're holding up above the bottom of that range that we spent the last couple of years, and we're only in the middle, right? So you can see, relatively speaking, tech names are holding up better, and there's a good reason for that. There's a lot of tech names that don't necessarily struggle the same way that a retail name's going to struggle during a shutdown like the kind that we're expecting right now. And so a lot of tech names are going to be able to withstand this better because they're based off the internet. You don't need to leave your house to access a lot of these companies, and so they're going to do better. And for the most part, tech names have been, relatively speaking, the stronger names throughout the last decade anyway. And so far, they're still holding up. I still think, for the most part, if you're looking to trade to the long side, if you're looking for bounces, if you're looking for names that are holding up better, you still want to trade tech names. And that's really the focus of a lot of the names you should be looking at are names that are tech companies that are holding up better than average. And overall, you can see that with the NASDAQ. Like I said, it's holding up pretty well. Again, if we look at the long-term chart, we look at the weekly, you can see where we stand. Now, it's been an ugly drop as well. It's not like the NASDAQ is holding up so well that it's not losing money. Obviously, we've had a huge drop on the Qs as well, but it's holding up when you look at it and you compare to past levels of support, it's holding up much better than the S&P 500, the Dow, or the Russell 2000. Um, Now, as far as support levels, again, we have to go to the weekly chart to really examine where we could go because we're moving down so fast that we need to start looking at longer term levels. And as you can see, we're at a pretty decent level here around 171. It's right around the middle of this 188 or so to about 155 range. And if we lose that, then we're probably going to come all the way back down here into the 160 area, just above the bottom of that range in the low 150s, around 153, 154. So that's going to be the next key area, particularly if the S&P 500 loses its lows and the NASDAQ follows suit, then the NASDAQ may come down to the bottom of that range. If we find support here, you can see a critical level for the NASDAQ is going to be up here around 187 to 186. Right? You can see again the selling pressure. As the last couple of days we tried to bounce above that and failed. So that's the key level we need to get above, is maybe about 185 or so, which is pretty close to the top of that range that we spent most of 2017, 2018, and 2019 in. And if we can get above that, well then, there's more resistance up here around 193, 194, but probably the same as the S&P 500. It's going to be what happens as we come up and approach the 20-pair moving average. This is an area, again, if you're looking for longs, you want to focus on tech names. We'll discuss it in more detail once we cover the four major markets and some of the tech names that I like and why I like them. But for now, let's just say that the tech and NASDAQ is one of the areas you want to focus on if you're looking for plays to the long side. Other than that, there's not a lot to say. I think that this is a market that, like I said, we don't want to be too aggressive trading it. There's not a lot for me to tell you as far as price levels are concerned. We've shot through a lot of them, and with the news that keeps coming out overnight, the news is so strong and so dire that we're just going to cut through price levels regardless of what price levels they might be and the significance of them. And that's going to be the nature of a market that is this panicky. Is that the technical levels aren't going to hold as well as they do when there's not a lot of news impacting the market. There's really not much else to say. Like I said, as far as where we stand right now, we're kind of at a support level. If we fail that, we're going to head down probably into the low 160s and high 150s. If we could bounce, we need to get above 185 or so. If we can get above 185, I think that means we can sustain a bounce up to the moving averages, but not much past them. Now, if we look at the Dow Jones is going to be weaker again compared to what we're seeing in the S&P 500 and what we're seeing on the NASDAQ. As you can see, it's shot right through support. It's come down pretty strongly. If we look at the weekly chart, we see where we stand compared to where we were, and we've just blown through all of the levels that we traded the last couple of years in. You look at what we spent 2018 through 2020 and or 2019, and we just blew through everything. We're already getting pretty close to the levels that we spent most of 2015 through 2017, and it's going to be the same. If we continue to drop down, expect to move all the way down here into the 180s on DIA, right? And this is the index that is followed most closely by the general public and by the media, and the fact that we're dropping only gives it more bombastic headlines and more outlandish things to say about the stock market. And honestly, at this point, we're in uncharted territory as far as how quickly we're moving through these levels. And if we don't find buyers here, then like I said, there's still room to the downside all the way to 180. So what we want right now, of course, is for buyers to step in and at the very least find a sustainable bounce to get us to start trading sideways and start to retrace some of this big drop that we've had. As you can see on the weekly chart, we've gone straight down. Typically, when you have a move of this magnitude, you're going to have something like this where you go down, you try to bounce, you drop to the next level, and then you try to bounce a little bit more strongly and possibly even drop one more time before you get a sustained bottom, right? So if that's the case, we still have more downside, a lot more downside, and there's still room for a further drop in the market. Usually you don't have one big move down and then you just recover all the way to highs. Now, it does happen. It happened back at the end of 2018. But even in 2018, we had a drop, and then we had the sustained bounce, and then we had the next drop down before we finally bottomed and started to climb upwards. We haven't had the bounce, right? And so what I mean by that is if you take a look again at what we did in the end of 2018 was actually a pretty swift drop, and there was a lot of ugly volatility there. But if you look at it, we still had that bounce, that intermediate bounce, before we had the next move down. And we haven't gotten that yet with this market, right? So there's still, we're not done with the selling, and we're still looking at the ramifications of what's going to happen as we continue to shut down all of our all of our countries, like businesses and just economy in general is just being shut down. And we're still going to be paying that price once we do recover from this. These businesses, you can't just take a month or 2 months off and not expect to get a hit to your bottom line for the rest of the year. So there's going to be a struggle for us to recover, and it's not going to be something where we just bounce all the way back to highs. And so what we want right now is we want this drop to just be done so that we can start kind of retracing and have our next drop and then come back up and maybe stay somewhere in the range that we are right now, rather than continue to head down and start visiting the prices that we spent 2015 through 2017 in. If we did that at that point, things are going to get even worse than what they are right now. And I'm not trying to scare anyone. I'm just pointing out the fact that what we're seeing here, when you see a selling of this magnitude, it doesn't normally just stop immediately. It's like a train that needs to slow down before it could turn around and go back in the other direction. I think at this point the train's going too fast to just turn around. So we're going to need to see some of these bounces that are analogous to the brakes being hit and this downward pressure slowing down. And it's not really happening yet. All right, now the key levels with the Dow I don't think are quite as important as the S&P 500 and the NASDAQ. However, you saw where they were. Again, we have to go to the weekly chart because we're kind of uncharted territory from up close. But really, there's nothing substantial to support price until we get back down here into the 180 range. So there's a lot more downside before we hit a substantial area of support. We're really kind of just hanging in midair here, just a couple of maybe months of price action that are trying to sustain price here. If we can get a bounce, you can see pretty clearly there's going to be a tough area here around 215, 216. As we go to the daily, you'll see that's right where we sort of reversed course after trying to bounce. And that's right where we find ourselves now. Last Friday, we had a very nice bounce candle. It looked things were okay, and then over the weekend, more bad news pushed us back below this area. And so 216 to 215 is the area that's analogous to the levels we pointed out on the SPY and the NASDAQ as far as where we need to get back above in order to have a sustainable bounce that can make its way back up to our moving averages. Or in the case of the Dow Jones, maybe to 233, but probably not beyond that. And then finally, if you thought the Dow looked bad, here's what the Russell 2000 looks like. And again, when we look at the weekly chart, you'll see just how ugly it is. And you can see we're already at the bottom of the range that we spent 2015 through 2017 at. I'm going to have to zoom out a little bit so you can see it more clearly. And as always, if you're looking for selling pressure, if you're trying to figure out what's going to go down first, it's going to be the small caps. You can see where we stand here. We've already broke through the pivot from 2018 through the top of that range that we spent most of 2015 and 2016 at, and actually sliced all the way through the bottom of it. And all that's left is this little area where we had a temporary breakdown in the beginning of 2016. So, overall, this is just a disaster, and it's just continuing to drop. And at this point, we just have to hope we get a bounce to get the small caps to kind of slow down a bit and try to maintain this range. Again, going through the bottom of this range is a bad sign as far as what the other indices are going to do. On the bright side, the other indices have tended to pull the small caps up when they were ready to bounce, and not the other way around where the small caps brought them down. So the fact that we've lost this level is hopefully nothing more than an indication that small caps are weak rather than that the entire market is going to follow suit and come this way. But at this point, you have to assume that the other markets may try to do this, considering the small caps have already come down to this range. We need to get back above 103 at the very least on IWM. If we can get back above 103, we can maybe get a bounce back up into this area around 110 or so. Anything above that is just gravy, but really just we need to stop dropping through this price range, and at the very least hold up through the range that we spent most of 2014, 15, 16, 17 in. And if we can get back above that and into that range, then that should at least show that the markets are ready to find some sustainable bouncing and some sustainable buying. And until we see that, that's you kind of want to stay clear again, like I said, and just be very cautious of how you want to go ahead and approach these markets. Now, at this point, you might be wondering, well, should I be raising cash? And at this point, I would say no. We're too far down for you to raise cash. You would want to wait for the next bounce. So what, Ray? We just got halted again? All markets halted, yeah. So we hit a circuit breaker. And hopefully, like I said, we could find a bounce as we approach the rest of the day. Let's see what we have here. Yeah, we had a circuit breaker. So let's go to the 5-minute chart and take a look. Yep, I mean, it is what it is, right? Like I said, we're not in a good state right now, and it's unfortunate that it's been this fast, and really it's been pretty hard for anyone to kind of react to this, right? Because we only had this one little 3-day bounce. Then from there, it's just been just basically a race down to the bottom, and it's been very difficult for traders to try to raise cash or to try to enter some defensive positions because we haven't had the market even take a breather in order to give them the chance to do that. And I think that's really the next step is once we do get a breather, once we get a breather, then we'll be able to maybe start and become a little bit more defensive about this. All right. That covers it for the 4 markets. Like I said, obviously they're not moving at the moment, but let's take a quick look at the U.S. dollar, and then we'll move on to looking at some charts and some chart ideas. The U.S. dollar finally bouncing a bit. Had a very strong move recently, and it finally started bouncing a bit. If we look at the euro U.S. dollar, you can see the euro gave back that entire move. So the volatility we're seeing in the markets, we're seeing it across the currencies as well. And this is a massive, massive move back up and down. Now this, of course, is reverse, right? So down is bad for the euro and good for the U.S. dollar. And the euro gave up that entire bounce, which is pretty amazing to me. It's come all the way back down to what it considers support level. And I don't even know what else to say about this. This is a huge move as well, and it mirrors the sort of panicky trading that we're seeing right now across the board, right? That's why we get stuff like the markets getting halted. That's why you see currencies make these ridiculous moves. That's why you see what the stock market's doing. We're in a situation where it's basically a global state of panic. And the scary thing to me isn't what's happening right now. Are we going to start acting like this every time there's an epidemic? Because let's face it, we face these kind of flu viruses every 2 or 3 years, every 4 years. And if this is going to be the new way to react to that, we need to, as traders, find ways to insulate ourselves from this sort of a drop if it starts to happen more regularly. But anyway, yeah, the euro is struggling. If we look at the U.S. versus the Canadian, that's really the one area where the U.S. dollar is showing strength. And again, this is really Canadian weakness because so much of Canada's trade, especially versus the dollar, is versus the U.S. is on oil. And this is basically like an inverse trade of oil. And as you can see, oil has been massacred and continues to massacre. Or get massacred. And as long as this continues, the worse oil does, the better the U.S. is going to do versus the Canadian dollar. Then finally we have the U.S. yen. And you can see the U.S. dollar gained some back versus the yen, but again, look at the crazy volatility that's coming in, showing this just the state of emotionality that we're seeing across the globe. It's not even just the U.S. markets; it's just everything in general is in a panic state, and we're just getting this crazy volatility back and forth. Like I said, if you're a day trader or someone that trades short term, this is the kind of volatility you dream of, because every day you get these massive swings back and forth on every equity, whether it's the futures market, whether it's stocks, whether it's currencies, even cryptocurrencies. There's massive volatility and these wild swings back and forth. And if you're day trading, you can get a lot more return now than you normally can. And then, like I said, oil. We'll get to gold and silver in a second. But if you look at oil and the state that it's been in, yes, Ray, that's if you're having trouble right now with the U.S. Canadian, it's because of oil. And oil's just, I mean, let's face it. If the entire country is being shut down, there's no money. There's no energy expenses that are necessary. The demand for oil is going to drop, and that's what's been happening. So it's been happening for a while, and it's probably not going to recover for a while. You would think, well, it's oil, it's going to recover, and it will eventually. But until we start to return to work, until we start seeing businesses return and start spending money again, you see people start traveling again, you're not going to see oil really recover yet, and bounce. And until we see that, we're going to see the ramifications of that, like we have been recently. Now, the last thing we want to do is look at gold and silver. Gold and silver is another one. I'm not sure I understand why gold has dropped recently. I feel like in these flight to safety moments, that gold should be doing better than it is. It's actually dropped as well, which is very strange. Usually when a market craters like this, gold does well. And that's not the case. I'm not really sure I understand why. Most of you guys should know by now, I'm a technical trader. I'm not a fundamentals trader. But generally speaking, when you have a market in a panic like this and money flowing out of it, it tries to flow to safety, and it's not flowing to gold as well as it should. And it's struggled. Silver has been even worse, as it's really cratered. And if you look at the gold miners, they've really struggled as well. Ray, I know you were in JNUG and the opposite one, and as you can see, JNUG had this insane drop, especially when this is what happens when you're on the wrong side of a triple leverage move. I know the other one did well for you, but this one, you can see this is why it's so difficult, or why you don't want to be in these things long term, is once things start to go against you, they really accelerate. And even the bounce isn't really as sustainable as it should be, unless, again, you're just day trading 1 or 2 days. And so gold, silver, the gold miners, they're all struggling. It seems like everything is struggling unless you're on the opposite end of some of these trades. And really that's basically a snapshot of the markets and commodities. I'm not interested in gold and silver right now. There is volatility coming in, but it's not really a trade that I'm looking to try to take advantage of. For those of you that have come every Wednesday, you'll know this isn't a trade. I've been kind of staying away from gold and silver. I didn't really like the pattern that it was forming, and I didn't like the way it was behaving, especially the way it should be behaving differently than it is right now. And I don't know what it is, but either way, if I don't understand why it's not doing something, I'm not going to go ahead and get involved with it. Right? So that covers it for the four markets, the four major market ETFs, and gold, silver, oil, the dollar. To recap, basically, if you don't need to trade, you probably shouldn't be trading right now. If you have a retirement account that's down, just understand that it's a retirement account. It's long term. The markets will recover eventually. Obviously, the government's pumping a lot of money back into it. So you just want to be patient. You don't want to make any kind of decisions based off of panic or off of fear. You want to be smart about how you go ahead and approach the market, and how you want to go ahead and approach trying to protect what you have right now. All right, so Ray, you all right, so maybe use SHY. Oh, bonds. Yeah, So that's like a hedge that you can be using. There's a couple ways of protecting yourself. Now, what I wanted to do here is those of you guys that have charts or chart requests, you can add it here. There's a few viewers in here. There's like 5 of you guys. If anyone in here has a chart you want me to look at, feel free to add it. What I'm going to do right now is I'm just going to go over. So on my Monday post, I put up ideas. Every time we have a drop like this, I mention how you want to build a watch list of names that you want to buy at a discount, names that you trust. So what I wanted to do is go over some names that I feel are probably going to bounce quicker because they're not quite as affected by the coronavirus as maybe what the hits that they've taken so far. So if you look at stuff like Amazon, and Amazon's always going to be the first name I point out whenever I'm looking at a market that, whenever you look at a big drop and you want to buy a name at a discount, Amazon's usually one of the first names that I want to buy. And as you can see, Amazon, yeah, it's taken a hit, but if you really think about it, people are still going to trade from home. Buy from home. Even if everyone is kind of being forced to stay basically at home and self-quarantined, you can still shop through Amazon, and you still have it delivered. If anything, delivery costs are down because oil prices are down. So despite the fact that Amazon has taken a hit, I think it's more suited to recover. It's in a better place to recover than some of the some of the retail names that we might see, or some of the restaurants, or some of the God forbid, like the cruise lines. They're going to take forever. Something like Carnival Cruise Lines is going to take forever to recover from the damage that it's taken. But I don't think Amazon is really. I don't think that the impact to Amazon is as bad as what the stock has shown so far. So what we want to look at is names like that, names that you think, that I think can recover a little bit better. So this is one of the names that I put up. Most of the FANG stocks, generally speaking, you want to take advantage when they drop because generally speaking, they will recover. If you look at a weekly chart of Facebook, now Facebook's struggling more than Amazon and more than Netflix, which is another one that I put up. But generally speaking, this is a name that it's all of its income is based off of the internet. It has nothing to do with going out into the public. So it really shouldn't. If anything, there should be more traffic in Facebook now than there has been over the last couple of weeks. So I don't see how it. I think it should weather the storm better than some of the other companies, some of the brick and mortar companies that we're seeing. Netflix again was another name that I went over that I think has a good chance of holding up, and it has held up decently. Another thing maybe you want to look at is names like Citrix and Zoom, which are teleconferencing websites or internet meetup, like virtual meeting companies. Obviously, they're going to be used a lot now as more and more workers get sent home to work from home. You have to have your online conferences, and a lot of companies are going to use either Citrix, like we used to use with GoToMeeting, or you can use like Zoom, which is another software that traders, or that just people in general use to meet online. And you can see that these companies have actually, not only have they held up well, some of them are already starting to recover, and some of them are starting to make their way back up towards highs. So stuff like that is going to behave well, and it's going to make sure that you aren't necessarily holding on to just the names that are getting hammered by the stock market, right? Like I said before, there are tech names that are holding up. It's not just a matter of trying to gamble on biotechs that that benefit from looking for a vaccine. There are tech names that respond well to this because they're not based off of things that have to happen publicly, right? It's the kind of stuff that happens from home conferencing and from staying at home, and being quarantined isn't going to stop you from getting on the internet. So as long as the internet's working, these companies are doing okay. Another area of strength that we did not go over on Monday, but if you take a look at it with the panic that's going on and how much people are going out trying to store and hoard food and paper towels and toilet paper and all that stuff, if you take a look at stuff like Walmart actually, look, they made new highs today, right? You take a look at something like Costco. Costco's holding up very well, and it's doing fine. You can go ahead and take a look at maybe like a grocery store like Kroger, new highs, right? So there are areas where if you're astute enough to pay attention, you could find places in the market that are holding up okay. You know, just think to yourself, well, what isn't going to be impacted by us staying at home, or what are supplies or what are certain services that we need regardless of whether we're sent home and we can't work for 3 or 4 weeks. Where are some areas that we still need to go ahead and use? There obviously something like Netflix, but even something like Peloton, um, if people still want to work out, they can still work out at home. And it's not done quite as well as some of these other companies, but you can see it's holding up okay, and it hasn't quite hit the lows that most of the stock market is doing. So there are ways for you to find names. If you just step back and think for a second, what kind of companies are not going to be hit as hard, or what kind of companies are still benefiting from the situation that we're in right now, and you'll see that there are areas where you can go ahead and find names that have already bounced. Now, granted, they've already bounced, and you might tell yourself, well, they've already bounced, so I missed a move, and that's true, but we're not necessarily out of the woods. There's still a lot of rumors circulating that we're still going to shut down, and that this, it's only going to get worse here as we continue to try to contain this virus from spreading further. And if that's the case, well then this situation might be exacerbated even more, and so some of these companies that are benefiting might end up benefiting more. And more than anything, I think the key is that these are the companies that eventually, when the dust clears and the market starts to resume its normal behavior, these are the companies that you're going to see weren't as affected as badly as the others, and so they're going to be the ones that, in the longer term, are going to hold up or recover more quickly than some names like Exxon. It's going to take forever for Exxon to recover. It's going to take forever for something like Carnival Cruise Lines to recover. Even getting a bailout, the airlines are going to take a while to recover. It's going to be a while before people are willing to go ahead and trade, to go ahead and travel. So some of these names are going to take longer to recover, and then you're going to have some of these names like Netflix. It shouldn't. There's no reason for them to not recover more quickly, because a lot of this drop is just based off of market fears, not necessarily off of fears contained to just Netflix, the stock. So they're going to be the kind of names that maybe hold up a little bit better than some of the others that we're looking at. Alright, so that's my 2 cents. Those are some of the names that I like, and some of the names that I'm watching. There are others, like I said. If you follow me on patreon.com/StockDarts, you'll see when I post updates like that, and I give you ideas of my trade ideas. And like I said, whatever we discuss on these Wednesday webinars, whenever I say, oh, I'm looking at building watch lists, or I say this is how I'm trading the market, if you don't really understand what I'm saying, or you want to see concrete examples of it, then go ahead and visit that website, patreon.com/StockDarts, and that's where you'll see these ideas being put to action, and see exactly how I go ahead and trade and implement the trades that I try to take or try to mention during these Wednesday webinars or these Wednesday market streams. So if anyone has a chart request, like I said, feel free to add it. I'm kind of out of ideas here, so if you guys have something that you want me to take a look at, cool. If not, we can go ahead and call it a day. For those of you that are always wondering, well, where can I find stuff like this? You can always go to Finviz, finviz.com. It's a free website. You just go in here and you go to the screener, right? So you come up here to screener, and then, so for in this case, you look, I just said grocery stores, right? You go ahead and you have a synopsis of some of the major grocery stores, and that's where you can see Kroger. That's where you can see this one, Grocery Outlet. iFresh. There's a few of them on there, and some of them are doing better than others, but overall, for the most part, you can see it's an area that's held up much better than most of the market, right? So if you're always wondering, this is one of the places you could go. Just come over here. You could look at, say, maybe you want safety. You could look at utilities, see how they're performing compared to the market. And for the most part, they should be holding up okay. There's a lot more drops. It's not quite as insulated as some of these other areas that we mentioned before. But you can come in here and just pick a bunch of different areas, right? So if you want to look at names that are going to get hit hard, you can look at oil, right? Look at oil names, and you'll see that most of them are struggling big time because of the drop in crude and the drop in demand in oil. And so these are the kind of names, if you were looking for a short and you want to wait, you look at these names and wait for them to bounce and then take advantage of that, right? So that's a good way to go ahead and get some ideas if you're struggling to find stuff. Ray, you want me to look at Freeport McMoran? There's another one, Ray, that's going to probably is probably going to struggle. Um, Freeport McMoran, it's for the most part you're looking at industrial like metal, right? Because it's copper for the most part. Um, and when there's going to be less demand for us to do stuff, it's going to drop in price, and you can see it's been hit pretty good. I would put this in the category of names that's going to take longer to recover rather than to recover quickly. So this is not a name that I'd be excited about trading. It's not a name that I'd be looking to find a bottom on. It's the kind of name that I'd probably just stay away from for now. I suspect that you're already in it. And I can't believe that you're telling me that you need to sell J Nugget. I don't know why you are still in J Nugget. I'm not. I'm done with that conversation with you, Ray. Um, so we'll look at Freeport McMoran. J Nugget. There's no reason for you to be in that. When they had that drop, that's why you have stops. So Freeport McMoran, same thing. You shouldn't be in this. I suspect you are, but you shouldn't be in this right now. You can see it's dropping. It's down 20% just today. The cheaper it gets, the more percentage is going to be down. At some point, yeah, some point it'll bounce $1, but that dollar's not going to make up for the $10 that you've already lost on this, assuming you were in this from back when it was trading sideways, or from the last time we looked at it. And like I said, we're probably gonna hit a recession. We're probably gonna the economy is gonna slow down. We're not gonna recover from this quickly, and our need for industrial supplies, for industrial metals, is not going to respond, and it's not going to escalate as quickly as you'd want it to. So it's going to be a while before this thing takes off and start to come back up to its prior ranges. And unfortunately, it wasn't doing that well to begin with, even before this whole coronavirus thing, right? You take a look at it on the weekly chart, you look at what FCX has done, and it's kind of been struggling for a while, right? And it already lost 950, which is a very critical level, and it's coming all the way back down now. It's getting close to all-time lows again, so probably going to be due for a bounce at that point. But this is one of those names, again, if you're in this, you're looking for $2 or $3 of upside. So unless you're severely oversized in it, you're not going to get the return you really want on this. Yeah, I don't know, Ray. I'm not into this. I don't think I'd want to be in this. You find it reverses with gold. Yeah, I mean it's a metal, right? It's a precious metal. It's more industrial than it is gold, which is just precious metals. Um, it will bounce, but I feel like the names that I outlined already, I think are more set up in a market like this that's in a state of panic, where basically any day you look at it, it could drop into and do it. You can get a limit halt. Um, you want to get the names that are more they're more set up for a bounce than stuff like this that's going to need a lot of things to happen before it's ready to bounce. And like I said, I'm looking personally myself. I'm looking for names right now that have not been that impacted by what's going on and are more set up to recover it than maybe something like Freeport McMoran is. Okay. So I hope that helps. And J Nugget, I'm not gonna. Yep, we're not even gonna talk about that. I told you to sell that. I don't know how long ago. That's an instrument for day trading, and you've held it for almost a year now, which I don't even, probably more than a year. You should not be in it, especially when it has the drops that it's had. It's never going to recover back. Whatever your break-even price is, J Nugget will never get back to that until it reverse splits. Okay. All right. Well, that kind of covers it for today. Those of you that are in here that hopefully you got something out of this. Like I said, if you have any questions you didn't want to ask here, you can always ask me on Twitter. You can ask me in our Discord chat, or you can email me, and I'll be more than happy to answer them. Other than that, thank you for coming and participating, and I'll see you guys next Wednesday.